Okay, this is the final video on our stock market investing strategy. So basically, if you want to know more about us, selfmanaged360.com, we provide modules on stock market investing, on different aspects of stock market investing, how to evaluate companies. We also provide modules on real estate investing and also on project management. I myself is a project manager last 15 years, so there's some interesting information available on our website. And you can also become a member, and we provide access to a portfolio that we built based on the investing strategy that we've explained in these videos. So basically, to conclude, Self-Managed 360 investment strategy is based on investing long-term. So we don't want to get caught in short-term investment. We don't want to get caught in the emotionality of the stock markets. We want to reduce our tax burden. We want to own companies long-term to reduce our transactions. And we're willing to keep ownership of solid companies even if the markets are going down for a while, because we believe that the solid financial performance and fundamentals of a good company will at the end be reflected in its price, even if the stock markets can go up and down once in a while. So we don't want to get caught in the hype. We are going to invest in companies that meet our criteria. Our criteria include profitability, so invest in companies that are profitable. Invest in business models that have proven to be profitable. Try to stay away from companies that are not making a profit yet. Invest in companies that generate cash and value for its shareholders, because at the end of the day, you are going to be a shareholder if you decide to invest in a company. So look at the financial statement, the income statement for profitability, the cash flow statement as well for profitability, and to see if it generates cash, and the balance sheet to verify the financial health of a company, and if it's generate value to the shareholders by looking at the shareholders' equity. See if the equity is going up or if it's not. So we want to invest in companies that is increasing its equity, shareholders' equity. Keep an eye on its financial health. Look for trends. Obviously, we want to see increasing revenues, increasing net income, increasing shareholders' equity. Look for trends. Keep an eye on its financial health, but mostly update your assessment once in a while. It's not because a company met all of your criteria today that is going to be meeting your criteria in 5 years or in 2 years from now. So it's good to update our assessment of a company once in a while, ideally every quarter, if not every time a company publish a annual report, so we can review the latest financial statements. In terms of valuation, we don't want to invest in companies that are overvalued, so we want to pay a fair price, ideally a discount price. So use ratios such as price to earnings, and compare the price to earning valuation of a company to its peers and to the average price to earnings of the industry in which your company is operating. We've seen the importance of assessing the return on equity. So by using return on equity of a company that has fairly predictable income statements, we can predict. Predict is a big word, but we can forecast what could be or potential return on our investment in 5, 10, 15 years from now by using return on equity. So it's a key value that we keep an eye on, obviously. you need to consider the overall sentiment of the market about a company. To do so, we consider the opinions of analysts, not necessarily of shareholders or other investors, but from professional analysts that are their job is to provide reports, neutral reports on the overall financial performance of a company. So this can be very useful. Again, update your assessment of your stocks that you own and stocks that you're tracking. You may be tracking stocks that you don't yet own, but you want to keep them in the loop in case one of these stocks become a good investment opportunity for you. And obviously look for weaknesses or opportunities to buy. So if a company that you own starts to weaken in terms of profitability or financial health, you may want to pull the trigger and sell it sooner rather than later. And the same thing goes with stocks that you don't own yet. If you see an opportunity, maybe a price drop for no justified reasons, you may want to jump in and purchase some shares to take a position as an owner of this company, at least a part owner by purchasing shares. Remember to think about the fiscal impact on your decisions. If you decide to sell or hold, you should remember that if you make a profit, a capital gain, you'll have to pay tax on it. As well, if you collect the dividends, you will have to pay taxes because dividends are considered as income. So you may have to manage your portfolio, your decisions to buy or sell, your decision to invest in a high yield dividend company. You must remember that you will most probably have to pay tax on the capital gain or on your dividends. Finally, remember to diversify your portfolio, not too much. We want to own enough stocks to protect us from potentially one of the stocks we own that could potentially go down quite a lot. So if we're diversified, we are protecting ourselves. If we over-diversify, what will happen is that we will most probably match the performance of the major indexes, and our goal or objective will be to do better than the indexes. So try to make sure that you diversify with your portfolio by investing in several stocks, good companies, but not too many. So we try to aim at between 15 and 25, depending on the size of your portfolio and depending on the opportunities that shows up. So if you need more information, as I said, visit us at selfmanage360.com. And if you want to become a member, we do share a portfolio with our members, as well as stock evaluation reports based on our assessments using our strategy, and the stock that we own on the portfolio, but also stocks that we track. So good luck.